Alright, recently a huge debate in the Discord link in the description is whether value or growth investing is the best way to approach it. You have one side of the spectrum which thinks that everything below a 9 PE is complete garbage and that companies like Walgreens, MPW, 3M, or your typical value stocks with not a lot of growth ahead of them but they're being priced at a severe discount are all just complete garbage and it's a waste of time and you should rather just be investing in growth stocks and let your money compound over the long term. So I decided the best way to experiment which one will be better over the long term is to make two separate portfolios. Today I'll be sharing my value portfolio. This is paper trading. I picked 10 stocks in each of the portfolios and put $1,000 in each. I'm going to be giving a monthly or quarterly update every month on the channel, so make sure to subscribe to keep updated on this portfolio experiment. And value and growth investors can be very different, but they can be similar if they buy the dividend stocks, not drugs merchandise, link in the description. We have some new designs out, the baby blue, which I think is absolutely beautiful. Also, we have a big Black Friday sale coming up, so make sure to keep an eye for that. With all that out of the way, let me know your favorite value stocks in the comment section right now, and of course, roll the intro.
Hello, I like money.
Alright, before we get into the actual holdings of the portfolio, my rationale, thesis, everything on that, basically with due to the holdings, I'd like to share the goals and objectives of the portfolio when I pick these stocks. Obviously, I wanted to find companies that had respectable quality. No MPW. The goal ideally here in these holdings is to find companies that are way below market value and that over the long term at these prices you'll get a market beating return. I definitely took valuation into account, unlike the growth portfolio, which I will be revealing later this week. I looked for companies with respectable financials, companies that I can envision being in society for the next 30-40 years, and of course companies with respectable quality. As I mentioned at the beginning, I'm not going to be putting any companies that I don't really think are financially strong and they're just being traded at a dirt PE ratio for being the dirt company that they are, frankly. I own some of these holdings and I don't own some of these holdings, so without further ado, let's get into it. To start off, of course, I had to go Target. Target was really a no-brainer. I believe Target is a very solid quality company that's being traded at a severe discount right now. I think that over the long term, at these prices, with Target and how they're being discounted right now and the amount of fear that's amongst retail, and more specifically Target, with the recent controversy they've been in, the decline in free cash flow last year, there's a lot of fear around it. But Warren Buffett always says to be greedy when others are fearful, and I believe right now is a very solid time to be greedy. I believe Target has short-term issues that they're dealing with right now, and as a long-term investor, I need to put those aside. Target, I believe, is a B-tier quality company that over time, during the good times and the bad, will average out. I believe it is a solid quality company that I've been owning for a while before the stock even went down, and I don't think anything fundamentally has changed with the business in that time. So with that said, I'm continuing to personally buy Target in my portfolio. With this, it was really a no-brainer. I thought I got it at a really good price. Target actually reports earnings this week, and I will be making a live reaction video to it. So the first holding is Target. Next, we actually have a pretty high grower for being a value play, which is Vici Properties, stock ticker VICI. Real estate has been getting killed this year due to the high interest rates. Investors want nothing to do with real estate overall right now, which I mean ideally over the long term is the perfect time to buy. So me personally, I've been buying more real estate in my portfolio this year, but I think Vici right now is pretty under where they're intrinsically valued. I believe they're intrinsically fair priced at $34 to $37. I think Vici offers some dividend yield into the portfolio right now, and it offers some higher growth, especially for being a REIT. So I was actually happy to add Vici, and I think it's actually a much higher quality company than a lot of the others on this list. I own Vici in my portfolio as well, and it's becoming a core position actually, and I'm getting pretty big dividends that I'm reinvesting every quarter from them. Next we have PayPal, stock ticker PYPL. PayPal has been getting demolished recently to say the least. Now, there are a lot of things that you could do with PayPal, including buying the dividend stocks, not drugs merchandise, link in description. Financially speaking, I think PayPal is a very solid company. They barely have any debt. Free cash flow, they're positive right now, and they're actually growing, and their revenue looks pretty solid. With that said, though, this is a company that's trading near $320 in 2021. Now, I'm no stranger to companies falling from 2021 highs, as in Target. Personally, I am a fan of PayPal. I like their service. I like their app. I like everything to do with it. Now, personally, when it comes to the business itself, I'm not an expert on it itself, and that's why I personally haven't invested. But I see a company like this with a very strong product that is very consumer easy to use. I see solid financials that really haven't looked like they've been crazily impacted yet with this crazy jump that they've had in the price, and I think it's a decent opportunity. So me personally in my portfolio, I'm not looking to add PayPal. I think it's a solid higher growth option compared to other companies on this list, and I think it is trading at a pretty attractive valuation just looking at the numbers. Alright, hello darkness, my old friend. We got Intel now. Now, if you guys don't know, I bought Intel at $55 2 years ago. I basically bought it because another YouTuber said to buy it. I did not look into the bear case whatsoever. I did not understand the business whatsoever, and I paid for it. So I sold my Intel last year at a pretty big loss. Now it wasn't anything crazy. I didn't own a whole lot of it, but percentage-wise, it was a big loss. With that said, though, I do think long-term Intel is a recovery play. Recovery plays are typically cheaper valuation, but there is a reason they're down. With Intel, it was their crazy capital expenditures that they're doing. Not a lot of investors last year in the market wanted to be placing bets on companies. They wanted to be buying investments. Intel is a company that obviously is going to benefit long term with semiconductors. Now, with that said, though, me personally, I don't own any Intel in my portfolio because it doesn't meet my personal goals. And the high capital expenditures, I'm not a huge fan of it, and their healthy competitive dividends. I was not a big fan of Pat Gelsinger and how he kind of did not give any warning to the dividend cut. Now, with that said, though, I think Intel is trading at a pretty cheap valuation for the type of company and type of growth ahead of them potentially. I definitely do think Intel is a riskier business, and me personally, for my own portfolio, I don't see why I should take that risk when I could just buy something that I know much better like Visa with much higher growth ahead of it. While we're on the topic of companies that I'm really down big on, next we got 3M, stock ticker MMM. Now, there's nothing tasty about 3M right now as a company, as they've been trading down wildly over the last couple of years. If you would have asked me 5 or 6 years ago, or most investors, what do you think of 3M as a holding, they'd said it'd be an amazing long-term holding. It's not going anywhere. Well, since then, the stock price has fallen in half, their dividend is now in jeopardy, and now they're dealing with lawsuits. Now, those lawsuits have been resolved, and it looks like as a result, their free cash flows will be impacted for a while. But I do think right now, at 3M's current valuation, over the long term, if you're willing to be patient for a few years, 3M could be a decent opportunity. They're a giant of a company, their actual business is running just fine, but there's not a lot of growth ahead of it. So me personally, in my portfolio, I'm not buying any more 3M right now. I'm just holding on and kind of reevaluating what I'm doing with it. I'm most likely going to hold because I think it would be stupid to sell at like a 30 or 40% loss when I do believe still in the long-term vision of the company. Now, there's not going to be any crazy growth there when it comes to the revenues or free cash flows, especially in the next probably 5 or 6 years in the short to medium term. I think 3M is a good recovery play and their actual business is doing fine. In the short to medium term, though, there are definitely some real risks with them. Next, I have Discover Financial Services, was actually submitted by Fiscal. That was his vote. Right now, they're trading at a PE of 6, which is kind of crazy to think about. Their financials actually look decent when you look at them from a start. They have a solid growing free cash flow. They have a dividend that's been growing for a few years, and they overall look pretty good. Next, we have Hershey, and Hershey is a company that I made a stock analysis video on a few weeks ago. I'd highly recommend you go check that out. But Hershey's getting down there in the prices. I actually used to own Hershey in my portfolio. I sold out at $230. I thought a better opportunity, and I sold out with gains. I do think it is a very high quality company, though. They have some really solid growth, and they've been on a pretty solid decline recently. I think if Hershey were to get to 180 or 170, it would definitely be a candidate to be in my portfolio. Now, I do have questions about potentially where that growth could be coming from in the future and how sustainable that double-digit growth is. With that said, though, they've been very impressive recently, financially speaking. So Hershey's a very solid company, and it was definitely a no-brainer when it added to this portfolio. I think it has some really solid quality, and it's on a discount right now. If you guys want to talk about more depressing stocks, next we have Disney, stock ticker DAS. Now, Disney actually just reported a crazy earnings report last week. They added a whole lot of new subscribers. Their free cash flow is in the positive department, and things are looking up for them again. Now, there is still a lot of uncertainty surrounding them, and a lot of people have been calling for Nelson Peltz to join their board and kind of hold them more accountable. Disney also announced that they intend to bring back their dividend by the end of the year, and it was highly recommended to their board by their new CFO. Now, will they actually do it? I don't know. Let me know in the comment section. We've had debates about this on the Discord. The fact of the matter is that Disney's had a piss-poor return over the last 10 years. Their stock price has not been good recently, but this is definitely a recovery play, I think. In my portfolio, I've not been adding to Disney, but with this recent free cash flow in the positive again, I might be taking a second look. It's obvious that Disney has amazing brands that they own, but I don't think they've been reaching their full potential with them over the last couple of years. I think if they can start producing blockbuster films again, it'll be huge for them, and their consistency in the free cash flow department too. Now, will Disney bring back that dividend? I don't know, but I think in this portfolio right now at the current valuation it's at, it's a solid recovery play. Of course, I couldn't make a value portfolio stock here without Altria stock ticker MO in it. Altria is one of the most infamous value stocks right now with their near 10% dividend yield. Nobody wants to touch Altria right now. I think they have some huge potential with their nicotine pouch brand on. Altria always trades at a crazy discount due to the nature of the business that they're in. But when you take that risk, you also get a reward, and in the short term, you get a 10% dividend yield as a reward. Now, Altria, I do think as a company, might be slowing down, but their dividend certainly is not. They expect to have an 80% payout ratio with an average 4% compound annual growth rate on the dividend, which right now, based off of current financials, is sustainable. Now, over the long term, are there definitely risks and concerns? Yes, but there always has been with Altria. Another huge reason that nobody wants to touch Altria today is because of the declining cigarette rates, but I think they have so much potential with vaping, nicotine pouches, as I mentioned, cannabis, and other industries that they're still tapping into. I think cigarettes will be gone in the long term, but I think these new markets will take over for that. I have a smaller size position in Altria. I understand the risk, but I also do think there is a potential value there, especially at these prices. Right now, though, I'm not buying any more, but I am reinvesting my pretty large dividend right now that has been snowballing and growing without me buying any more. I'm reinvesting that every quarter, and my payments are getting larger by the quarter. And the last holding is, of course, Realty, not Reality Income. Now, Realty Income is most infamous for its monthly dividend. I actually just made a Realty Income video, and I've made other videos based on Realty Income on the channel. At the end of the day, I think it's an okay read. I don't think it's great, which I mean, that's kind of the reason that I haven't been really buying recently, but I think right now with the recent price decline, it is undervalued for sure. Now, me personally, I've been kind of hesitant to add because of the way slower growth that they've had, but if they get back down to 45, I'm definitely going to be a lot more interested than I'm at right now. I would say this though, if Realty Income goes back up to where near I bought it at, I'm probably going to be selling out due to the lower growth. Right now, I do think it is undervalued though, so I'm just reinvesting my dividends for now. I'm not a giant fan of the recent stock dilution and the debt that they've taken on, and the recent acquisition that they did. I made a video on that as I mentioned. So with Realty Income, me personally, I'm not really looking to add any more into my portfolio unless it's at the right value. But in this portfolio, it's a value portfolio, so I'm going to be adding Realty Income. And that's the portfolio, guys. Let me know your thoughts on the portfolio in the comments section. Overall, this is definitely straying away from my personal style of investing. But with that said, though, this works for some people. But over the long term, I will be providing you guys updates on this portfolio, and I also have a growth one where I completely disregarded valuation. So it will definitely be fun over time just to see which outperforms, which underperforms, and of course, over the long term, seeing which one comes out on top. Let me know your predictions in the comments section. I want to thank you so much. If you haven't already, make sure to go check out the merchandise, link in the description. I'd greatly appreciate it. You don't have to buy, just go check it out. Thank you all, and of course, do dividend stocks, not drugs. Have a good one.